Welcome to the Broken Pie Chart Podcast, episode 72. I'm your host, Derek Moore, and with me today is my, semi-co-host, part-time co-host.
I am here often enough. You might be able to throw that moniker on it. Yes.
People may, I will say who you are, of course, for people tuning in for the first time. It's Jay Pestrichelli, CEO of ZEGA Financial. But yeah, Jay, you've been on enough that people start to recognize you. So welcome again.
Thank you. As always, a pleasure, Derek.
So, today you and I were having a discussion, I think late last week, and we said, we should just record this. So, it's the idea we're starting to see more and more about the lower for longer. And we say lower for longer, we're talking about lower interest rates for longer treasury yields for longer. And there's some talk too about maybe rates going negative. And we can touch on that maybe in a bit. We actually have seen negative yield to maturity inflation protected bonds go off. But, Jay, I've looked at many years of data. I know we've looked at people have sent us stuff that goes back, I think, to the 1300s. There's a book, The History of Interest Rates. Like if you really want to learn about interest rates, it's like a 1,000-page book. I'll link to it in the show notes. Goes back to, during Roman times, like somebody saying, here, you can have this, but you have to give me collateral. But I don't know, Jay. I mean, I think I want to explore this a little bit, and then I want to eventually lead to like, what's the alternative for people? But in my mind, when everybody has one position, maybe we will see inflation. But right now, Jay, it's lower for longer. And then, of course, we have the Fed. Never fight the Fed, right?
Yeah. And, when you say lower for longer, and I know you explained you're talking about lower interest rates will be around for a while. Before we get off that topic, I'd ask you, and I know you know the answer to this, can you think of any countries that have had very low interest rates for a long time, right? Is there any other, period or active financial system that has experienced lower for longer, or is this totally unique to what we're going through right now?
Japan is the case study, and more recently Europe. So Japan experimented and is still experimenting with negative rates. Their central bank actually owns about 300 billion equivalent US dollars on their balance sheet, not only in bonds or bond ETFs, but also some stock ETFs. And then more recently Europe. And there is some mixed thoughts about that. Some people look at the Japan experiment and say it actually didn't cause inflation, it caused deflation. But interestingly enough, on the equity side, we have not seen the Tokyo, the Nikkei index based in Tokyo. We've never seen that reach its all-time highs set in the 80s. So, it's kind of an interesting dichotomy of the markets and bonds there.
Yeah, and I think, and you clarify this a little bit, when you hear negative rates, it's because the net return at the end of the time period of the bond is you got back less than you put in initially, right? So you would be paying a higher premium up front. Yes, you'd be getting some interest, but no, it's not like you have to write a check to the Bank of Tokyo or to the government of Tokyo every month because you've got a negative yielding bond, right? It's because you just paid a higher premium. Is that accurate?
If people are driving, don't do this. But if you have a pen, it's kind of like, bonds are priced at maturity at par, which is $100 or $1,000 per bond. So let's say you buy the bond at greater than $1,000. Well, eventually at maturity, if you hold it long enough, you're going to get your $1,000 back, excluding defaults. And then the bond can pay a coupon. But that's right. Let's say you only receive $50 at the life of the bond, but you lost $100 on the purchase price. And when I say got up $50, that's the interest payments that you received. But if you bought it for more than it matured at, you lost that. So overall, you've lost money. You also could have a bond that doesn't pay any interest, and you just pay more for the bond than par. But yeah, Jay, as of yet, they have not figured out a way to make you send a check into the various treasuries. That's right.
And why would anybody do that? Like, why, if you knew buying this bond means I get back less money than when I started with, do you want to kind of enlighten the listeners why people would even do such a thing?
Well, there's two main purchasers who just do it without getting too much into it, but it's governments, it's central banks. They just buy them. and they're doing that to increase the money supply or other reasons. Large pension funds, they've got to. I think there's some regulatory requirement they do that. But also, there's really large ETFs and mutual funds. For example, Vanguard has an international. It's the AGG equivalent, but it's international. So the aggregate bond fund, but it's global. And so if that's the fund and that's your mandate, they've got bonds in there that have negative yield to maturity. But the reason why strategically you would do it is that if interest rates were all else equal, right, and it never is, but rating stays the same and everything else stays the same. If interest rates go down, and you have a bond that pays a higher interest rate, and by higher, it could be negative half a point, and then they go to negative 2%, your bond will appreciate in value because of the present value of just the way we do bond calculations. So if you buy, a negative, let's say a 0%, to maturity bond, or a negative 0.1% bond, if rates go to negative 1%, and that's a 30-year duration, you'd expect that bond to go up, 27, 28, 30%. So it's an interest rate play if strategically that's why you want to do it.
Yeah, it's a directional trade, right? And you never had the intention of holding it to the maturity and getting back that less than what you paid for it, right? So there are reasons for it. It's very similar, maybe not similar in a way, but why recently when oil went negative, it was just a function of this just has to happen in the market because of the trading activity associated with, in that case, that contract. But we're talking about bonds here. So yeah, Derek, I thought it'd be interesting just to touch on that, because I think a lot of time people hear this concept of negative rates and it makes no sense. Heck, you even hear our president throw that out there from time to time, like, hey, why not lend money and get paid back more than what you owed, right? And I feel like in general, the population doesn't have just a grasp of why anybody would ever take cash and buy something when they know they're going to get back less than what they started with, for sure.
Yeah. And by the way, to clear something else up, I've heard people go on CNBC in our industry, and of course politicians who say all sorts of things, but they were like, hey, why don't we refinance our national debt, our 22, 23, I guess it's probably going to be 25 trillion soon. But the reality is that when the Treasury issues U.S. Treasury bonds, there's no call provision, meaning you can't call those back in. And so when rates went down and bonds went up in price, you'd have to buy them back at the market, which essentially means it's already basing in what the interest rate is. It's not going to work, in other words. But
yeah, but they can always issue new debt, right? Which is what we end up doing on a regular basis.
Jay, what is part of the thing with lower for longer too? Maybe we can switch to the equity side, and then I'll talk about maybe the home loan and cars. But just like what does low interest rates mean on the equity side, right? I mean, you and I don't do this for a living. I say, we're traders, we manage portfolios and all sorts of other things, but we're not like putting a value on a company. But people do that. They have to make estimations about earnings in the future, and then lower interest rates means that those earnings are worth more. What does that mean for equities?
Yeah, well, when your earnings are worth more, it says you can pay a higher price for that stock and feel better about it, right? Because, hey, the earnings are going to be worth more in the future. At the current price, I should be able to buy more. And so typically what we see when you have lower interest rates, you are going to have a higher equity market, an equity market that moves up more, right? Bonds and stocks are always linked, right? They just always are. They are the two main asset classes of the U.S. financial system. And everybody hears you should own a piece of stocks and bonds. I think we're going to talk a little bit about why it's hard to own bonds in a minute. But generally speaking, when rates go lower, it adds, when bonds go lower, it adds value to stocks, right? So as rates drop, companies can afford to borrow at cheaper rates, which means they can invest in their company. They could hire people that will help their growth. There's things they could make technology investments that will make them more efficient. Just think when they can borrow for less, it should yield a better top line. But there's another reason for it is the old Tina argument. There is no alternative. And where we are today, and we have definitely seen this with client portfolios and even the portfolios we manage, when rates get so low, it's just not even worth holding those bonds, you have to invest in the market. So not only do you have balance sheets which potentially can be stronger down the road and in the future, but you also have momentum that just adds to the supply and demand reason why stocks go up. More people want to buy Apple because they can't earn their money in bonds. So I give you kind of those two reasons for me when I think about why typically rates will drive stock prices higher.
Yeah, I mean, when you're looking at and usually it's the first couple of years, you say, okay, what are the earnings going to be in the next couple of years, or the market, right? The S&P earnings. And you say, okay, it's going to have a terminal growth rate. What the heck does that mean? It means you're assuming these companies go on for a long time. So if your risk-free rate, and the risk-free rate is typically the 3-month treasury. Why is that? Because you don't have duration interest rate risk. And the federal government, they may need to print money to pay you back, but you'll get paid back in theory, right? But when the risk-free rate is so low, the discounting mechanism is also low. The other reason I'll throw out there too, and you mentioned there is no other alternative. Somebody like Aswath Damodaran from NYU does a lot of work on the equity risk premium, and it's kind of like, what should you expect in stocks or your investments over the risk-free rate? I think there's also, if you look at the 70s or the early 80s, in theory, like why would you own equities, right? And people look now and they say, well, is the equity risk premium? But I think there's an emotional side of this, and I'll explain. When bonds can give you 8 or 9%, you probably would be like, you know what, I'll switch to stocks, but I want 15%. But if rates are zero, Jay, I mean, if you're in stocks and you're getting like 5-6%, you're probably like, okay, I'll take 5-6%, right? Like I think on an emotional level, people require less. At the same time, as you described, in theory, asset prices can be a little more inflated, right?
Yeah, and you're right. The linkage between what you can get from a risk-free investment absolutely is going to impact your expectations on a riskier investment, like say stocks. And you're right, and it does level out your expectations. And risk and return are always linked. The concept of a risk-free rate of return is used a lot in our industry by portfolio managers like us that say, okay, how much better did I do than if I took no risk, right? And that's used. I don't care if it's a bond portfolio, a futures, commodities portfolio, stock portfolio. It doesn't matter. You're always rated against the risk-free rate, right? Did I do better than if I took very, very or no risk, right, at all? And so that leveling out of expectations on returns just happens across the industry, and it always comes back to where are interest rates, where are treasury rates, really.
Yeah, the other area that I see, we'll spend a little bit of time on this, and maybe then we'll go into like what's the risk of holding bonds. But I had a lot of people ask me, do low rates, will it help people buy more car, or how does it affect housing? The first thing I'll touch on, and then I'll kind of maybe your thoughts on it before I switch to car loans, because I have some really different thoughts, maybe some contrarian thoughts on that. But to give you some perspective, let's say that somebody buys a home for, I don't know, $625,000. Why $625,000? It just works out because 80% of that you're going to borrow, right? You put 20% down is $500,000. Nice, easy numbers. So at a 3% interest rate, which by the way, CNBC today on their screen, I think the 30-year went to 2.94. I don't know where they get that from. But at 3%, the principal and interest on that loan would be $2,108. Okay. So you could afford, if that's what your budget says, you could afford a $625,000 house, right? But at 5%, your payment would go to $2,684. At 7%, it's $3,326. To put a little more color on that, to have the same payment of $2,108 that you had at a 3% rate, you couldn't afford a $625,000 house. You could only afford a $491,000 and some change house at 5%. And then the other thing I'll just mention, I didn't realize, obviously everyone who has a mortgage knows you pay principal and interest, and early on you pay more interest than you do principal. But it's actually kind of fascinating. Your first payment on the $500,000 loan at 3% would be of the 2108, 1250 of interest and 858 of principal. Now, just for argument, I'm just going to change this real quick before I flip it to you, Jay. At a 7%, your payment goes to 3326, but your interest is 2916. Your principal is 409. So you're every time you make a payment, in this instance, at least your first payment, you would be putting half as much towards, and there's that break even. I don't want to make this a mortgage podcast, but Jay, I think this is one of the reasons why, there's two things at play. There's home prices, and some people say, well, interest rates going down is really good because I can afford more home. But the reason why maybe you can afford more home is because you have low rates. But low rates is definitely, in my opinion, causing at least to bolster, potentially inflate homes. I'm not an expert on homes. Don't buy or sell homes based on what I say. I don't know if you have any thoughts on that, though.
Yeah, so really, this is I think this is kind of a great real life example for everybody, just understanding how much more your money can buy when you pay less on the money you've borrowed, right? So in your example that you just gave, if your rate was between the 3%, you could buy a $625,000 house, or comparatively, if your rate was 5%, you're only buying a $491,000 house, right? That $130,000 difference is that's a pretty big deal. Now, do I think that the lower rates are causing all $491,000 homes to now be worth $625,000? That seems a little stark to me. However, it's certainly a factor. There's no doubt about it. So I do think you're absolutely right that lower rates can cause inflation in areas like housing. I think the other thing that we see with lower rates are things like refinancing, right? And so you may not even change houses, right? But you will be, like, why would I not want to save if I could drop from a 5 to 3%? Why would I not want to save that $580, per month, right? That's real money. That adds up over time. I did not realize the interest breakdown that you laid out on the higher rate versus the lower rate of how much of the principal you're paying down. That is interesting, but listen, that is the bank's got to get they're taking the risk, right? That you won't pay them back. I get why they want to get paid. When you think about why interest rates are what they are, it is a factor of your ability to pay it back, right? The bank looks at you and says, "Hey, what's your chance I'm going to get back this money that I lent you?" Right? And we know things like credit scores go into things like interest rates, but I think they end up taking a little more risk here as well, right? Now, granted, their asset that they're lending on is becoming more valuable potentially, right? And that they have, they have control of that. But in all, when you look at the big picture, I think in an environment like this, banks haven't been able to really price their default rates because of things like we're going through with the virus. And so let me just tie it all back to your point about inflation. I think there's also a chance that you could see, additional inflation due to, kind of the environment that we're in, just because of defaults, and banks will have to charge more. If the 30-year bond, right, and the 30-year treasury, I think, what do we say, is going for 1.5, 1.3, somewhere in that range, right? But yet banks are charging you 3%, or now, like you said, just 2.9 plus. That is the only thing that's the cushion, right? That the banks have, is the difference between what they borrow and what they can lend, that net interest margin. That is also something to think about, Derek. Do we think that, an increase in defaults and a decrease in the amount of cushion that the banks can work in between what they buy and they sell, do you think that's something that also can cause inflation in other areas of the market?
Yeah, I mean, I think so, and I think it's a bigger discussion, because when the Fed gets involved, they print money. That money has not caused inflation because it's gone into more financial assets and harder assets like housing. I I think you bring up a really interesting point about the risk to the banks. And we just mentioned, the US government can't call in bonds that are 2% and reissue them at, 0.7%. But you as a homeowner, you mentioned refinancing, like you have a call provision. And, if you do a mortgage and then inflation goes up, the value of your debt goes down. It gets inflated down. But you can always refinance. It's like a special privilege. And I don't want to turn this into a rent versus an own, but that's an often overlooked thing. I guess it's often overlooked too that you have to replace your water heater and any number of things, maintenance in the house.
Right. We probably shouldn't go down that path, but yes, you're right.
But I do think like if the spread narrows on what they can make on this, they probably have to make it up somewhere. And maybe that's where the inflation happens. But
that's exactly it, right? I mean, the banks have a responsibility and they have to maintain a balance sheet. And the reasons are because some people just won't pay back the banks, right? And I'm assuming right now a lot less people are going to be paying banks back now than they were, say, a year ago. And there's risk there, right? And I do think that the other things will eventually push higher, other fees and costs and lending. Costs associated with lending are all going to appreciate over time. So I don't know, it's interesting. I know where I am in Florida, we definitely are seeing an increase in housing prices. And it's not just because people want to, move to Florida, even though a lot of people do. And they are building here like crazy, right? And prices are still appreciating. So I do think, you're definitely onto something here about how much more you're willing to spend when your dollars can get you a bigger or a larger condo or a larger house. I think you're definitely onto something with that, Derek.
Yeah, you mentioned there's other factors, and I'll just mention it briefly. Obviously, wage increases, unemployment. I mean, that's a big driver of disposable income. But one area that I'll push back a little bit to those who are pointing to lower rates as the reason why car sales, have been, and I haven't looked at it recently, but it is interesting. Over the years, the average amount financed for new cars, I think it's either $32,000 or $35,000 now. And you think, well, that seems kind of crazy. And people say, well, it's the interest rates that are going down. But I ran some numbers. People used to do car loans at 36 months. That was the typical. And why 36? Because a car is a depreciating asset. Every day that you own it, it's kind of like selling options, time decay, right? Every day that it's out there, it's losing value. So a $35,000 car at a 7% interest rate for 36 months is a payment of $1,081. People are like, oh, wow, I wouldn't do that. Well, maybe you would do that. I don't know. But then you lower the rate to 2%. You think, oh, this is great. It only goes down to $1,002. The total amount that you wind up paying for the car goes up like $3,000, including your principal and interest. But what's happened in the car space, it's not interest rates going down, in my opinion. It's the duration of the loans. And so if you take that same $35,000 car and use a 2% interest rate for 72 months, now your payment's $516. And, at 0%, it's 46. And now I saw a couple weeks ago, they're doing, either no interest or low interest for 84 months. I don't know how this is another area I think I'm going to watch. And this is one of those, like, you could have called housing the top. I'm not calling the top in car sales. I'm just saying at some point, if interest rates rise or you got all these loans out there on cars that are depreciating, like in month 70, how much equity is going to be in a car depending upon what you have back? I just think it's an interesting situation that we'll see it on a 60 minutes piece at some point, right?
Well, so you get this initial pop because rates are low and it's easier to borrow to buy a car, right? And that's one of the benefits that you would expect the Fed is trying to drive by lowering rates, right? Hey, we want commerce. We want people to be able to spend money on large purchases, buy a car, get yourself to work, those kinds of things, keep the economic wheel moving. But so I do think you get this initial pop in just economic activity when rates go lower. Cars is the example. But now let's take this out. Hey, I'm in this this loan for 7 years. Do you think, Derek, that because you had a 7-year loan, you're really going to keep the car for 7 years? Do you think it really changes your behavior on the length of time that you keep a car? For me, I just happen to be one of those people that keep a car and I run it to the ground, right? I will take a loan and pay it off, early, and then, drive the thing into the ground, and then just hopefully it gets towed to the junkyard and I get a little money for parts, right? But, that's not everybody, right? And would you project that the lower borrowing rates would change the behavior because they had to go with a longer term on the loan, or people just say, I'm giving it up? I mean, I guess you'd be upside down on your loan by year 5 or 6, most likely, right? What you can get back for the car maybe it's harder to pay off the loan. I don't know. Have you thought about that? Because this is a unique thought, right, Derek? People haven't really thought about the fact that, are you really causing an issue with these longer loan terms when it comes to cars? Is that really changing things like sales projections and that kind of stuff? But
yes. Yes, Jay, it's
okay.
But I'll point to, I think, the Wall Street Journal. I linked to it if I could remember, but I think they had an article of where people are coming in and they do want a new car, not, before the 7 years or the 6 years. They come into the dealership and they're upside down, meaning they owe more than the car is worth. And I think I read in the Wall Street Journal, they're rolling that debt into the new. So now you get a new car loan and you got a portion of the old debt plus what you're paying for the new one, and your loan just keeps growing.
So
this is not going to be good. Yeah, this isn't going to be good for anyone. I don't know where it ends, but I expect, I'll make a prediction. The next 10 years, 60 Minutes will be doing a piece about, all sorts of issues with this. That's my prediction, Jay.
All right, you're on.
My other prediction, which so far has been wrong, but at some point it'll be right. And if you give a prediction enough time to be right, eventually it will be. And here it is. Let's talk about the risk of bonds and why people need alternatives. We mentioned earlier that, the rate on the 30-year Treasury, I think you said it was like 1.3%, 1.4%. The 10-year is less than 1%. It's 0.70. So to give you some perspective on that, that means that if you buy a bond for $1,000, assuming you buy it at par, and the great thing about doing podcasts from home offices, you do have some background noise, but that adds to the ambiance, Jay, if you can hear that.
Yeah, it's nice. It makes it more folksy.
It is. So anyway, $1,000, you buy this bond, you're getting $7 a year at 0.7% interest. That means over the course of 10 years, you would have received $70. Now, that same bond at a 10% rate, you would have gotten $100 a year. And over 10 years, not 70, but you would have received $1,000. So there's a couple risks here. And by the way, the 30-year, you can do your own calculations there. But what we're outlining here is this issue with not only you're not getting paid any interest, but bonds have been going down since 1981. 60-40 portfolios, guess what? They worked again because rates went down. You had a 1.7 10-year, it goes down to 0.7. You had a 3.5 to 30-year. I mean, I think 30-year bonds were up something like 25% at one point during the downturn. So people look at that and they say, I told you, bonds will keep working. But here's the thing. When interest rates are this low, you're not getting paid. And at some point, I mean, is it plausible that the 30-year might at some point go from 1.3 to 2.3? That would be a loss of around, back of the napkin, about 25%. If rates went from 1.3 to 3.3, you're looking at, 48%. This is what I wrote about in my book, Broken Pie Chart, available on Amazon, Jay. But I wrote about the target date surprise. And this is what I think, this is another 60-minute piece. You're going to see at some point where, rates go up. And by the way, it wouldn't take much. And people near retirement are going to be like, wait a second, I'm 70% in bonds, mostly treasuries. How did I lose this much? I'm not saying it's going to happen tomorrow because it happened. It hasn't happened for 30 years, right? But Jay, I don't know. I mean, that's the risk out there.
Yeah, let me kind of review it because I think it's an important fact here. So the first thing is, let's just get this out of the way for people that may not realize this. When rates go down, bonds go up in value, and when yields go up, bonds go down in value, right? So that's the dynamic that you're talking about. I think you used to do back in the day, Derek. We used to do a seesaw slide on this,
That's
right?
right.
So
That's right.
that's so. First, remember that relationship, right? It's yields go up. That means That means bonds went down, right? When yields go down, bonds are more expensive. They go back up. And so if you're at this, let's say, well, we know for the U.S. it's historic low bond rates, and it's been a downtrend for 30 years. Nobody can argue with that. But at some point, even just a minor rebound, right? I don't think anybody would feel, hey, it was a big change. Bonds went from 1% to 2%. Like that seems okay. What's the big deal? But it's a big deal when you have that seesaw effect. And I think you just laid out the differences in the underlying price of the bond itself. Now, if you hold the bond to maturity, this really isn't that much of an issue for you, right? But when you're holding things like bond funds that have that have durations targets that can't hold bonds to the end of their maturity, they have to trade out and buy new ones, right? And so what ends up happening is, because I'm getting to your target date point, what happens is that because vehicles like mutual funds and ETFs that hold bonds have to kind of constantly swap out and trade, they aren't holding to the end. They aren't getting back the $1,000 that they initially bought that bond for, right? They have to deal with what the market is willing to give them. And if rates have changed, if rates have gone up, the amount of money that they can get back for the bond that they previously bought is going to be less. And why is that? Is because people can go to the market and pay something and buy something that's paying more. So the one you have that has a lower rate built into the coupon as the market went up, you can't get as much money for. Right? So that dynamic, Derek, I think you're talking about here, which is, target date funds, which hold a portion of stocks and bonds. And as you get towards the maturity target date of that fund, they rotate from out of stocks into bonds. Right? And so again, sorry if I'm saying something that's really, really obvious here, but when you're in your last year of a target date fund, the odds are it's mostly treasuries to take less risk, because that's what modern portfolio theory tells you. Even though it's 70 years old, not so modern anymore, but that's what that tells you. Whereas, maybe we won't get on that. But and you have less stocks. You're almost all treasuries. You're almost all the quote unquote safer asset class. But if bond rates move quickly, and the funds that you're in, the funds that are being used within those funds, because most of the time those are funds of funds, you can find yourself in a position where what you thought was a safe investment is losing money because interest rates moved from a big whopping 1% to 2%. But the impact on the value of your fund that you're holding could be pretty dramatic. I said exactly what you said, just hopefully in a little different way. But I really wanted to hammer the point home that I think people don't realize this relationship between rising rates and dropping values of the bonds you're holding.
I think the one thing, and that's a great explanation that cleans up whatever I said very well.
Or muddied it up one way or another.
But the one point I would make, I wouldn't say correct you, but I would say I'll augment one of the things you said, is that you hold the bonds to maturity. Eventually you get your par value back. But I actually would say the risk there, if you own a 30-year bond, let's just simplify it, and it's paying 1.3%, and the bond goes down because interest rates went up, the reality is that you're getting an increasingly less amount of interest. You're not getting an inflation comparable return. In other words, if you're getting 1.3 and inflation's 4%, you're losing purchasing power each and every year. So yes, on the value of the bond, and I think it's and by the way, there's some. We'll probably have to do this another time, but there's some debate about the CPI. Inflation has been 1.5%, 2%. But something like what did I say was the Chatwood? I got to remember that Chapwood index. I'll link to it. They track like 500 of the most popular items in cities, and they see inflation like 7-8%. We know medical inflation, school books. There's inflation in different areas, but I think, Jay,
so you're touching on real inflation of what we actually
Yeah.
experience versus what the metrics are compared to things like bond prices, right?
Yeah, and you can go to Shadow Stats, and they have some different things. I'll link to all this stuff, but I think this plays into the fact that okay, look, if rates go down, you could see bond prices go up. By going down, like to see the same 30-year run, they'd have to go to like negative 20%, literally. Because they were close to that in 1981, right? But I think the need for an alternative here is a good pivot point because, in my opinion, I think in your opinion, like holding a bond that pays you next to nothing, where you have asymmetrical interest rate risk. Yes, if rates go down, if rates went down on the 200 basis points to like negative 1.5%, yeah, you could make like 50% on a 30-year treasury. But I think the problem is the holding cost and the fact you're not getting anything. You do have inflation risk. So we need an alternative. And I know it's something, we've been working on. You and our trader Mick have been spending a lot of time. So people, if they're like, okay, I don't want to hold bonds because of these things. And by the way, next year, you could see bonds go up if rates go down. I just want to be really clear. You could have a same situation that happened recently, but like, what's the alternative?
Yeah, so let's think about the characteristics here of why somebody would want bonds in their portfolio, right? And historically, what we've been taught, they are safer vehicles. They have kind of a predicted return, and you understand the kind of risk associated in a bond, especially if you're willing to hold it to the end. But the problem is, as we've already been pointing out for the last 40 minutes, that interest rates being this low are really not paying you what it's worth. I'm going to tell you, when I'm building a plan for an investor, I don't have any plans where I go, well, if I only make you 0.5% a year, we're going to hit our target. That's not part of any advisor's plan that they're building for people these days, right? Bonds are not a vehicle today. Certainly, U.S. government bonds, the safest kind of bonds. I'll probably go out on a limb when I say that they're considered some of the safest bonds out there.
Of course,
they just aren't going to pay you enough. So you need to take risks somewhere else, and you end up doing things like getting into stocks, which I'm going to buy Verizon that's got a 5% yield because I need more than just this 1% a year to hit my target. Right? You get forced into these positions where you have to take on additional risk. So, but it would be great if there was a version of an investment strategy where, I could take some risk, a little bit of risk and measure that, generate regular returns, almost predictable types of returns, so that I can hit targets that I built for investors, right? And we have been struggling with this over time, and we got to the point where we said, you know what, we're going to build an alternative. And so, yes, it is one of those things that we're just releasing now an alternative to bonds. We're calling it our bond replacement option strategy, where you use options to generate regular returns by scraping dividends off of equity type assets or ETF type assets, but doing it in a way where you've measured your risk and you've provided stability that you would expect from a bond. And so while these are not, I'm making little air quotes, synthetic bonds, these are strategies that are designed to mimic the desirable portions of bonds, like, lower volatility and risk and more predictable return. And that ends up being one of the advantages, Derek, that we think it makes sense to work with people like you, like me, that we can create things that give you solutions where traditional assets like stocks and bonds are not going to actually be able to solve your investment problem. But yeah, that has kind of driven us towards the low rates have really driven a need towards building a product that can replace bonds in a portfolio, because they're not giving you what you would expect or what you need for portfolios.
One of the things I think a lot of people don't realize is that, sometimes, and we like to use spreads. Spreads are you buy an option, sell an option, but you sort of define the risk. What a lot of people don't realize, Jay, is that the dividends, whether it be dividends on a high yield bond fund or a corporate bond fund, the dividends are reflected in the value or the premium of puts, right?
Exactly. Right. There's this. What a lot of people don't realize is that those the options have to reflect an upcoming dividend. And so if you're a seller of options, you can capture that dividend, at least a portion of it, right? It's not 100% dollar for dollar, like all things with options. There's always a level of it. But yeah, I mean, it is embedded in the option prices. I'm going to give you a really quick example, right? Let's say you have a stock, it's $100 and it's paying a $1 dividend. The day you'd normally get your dividend, the stock would go from 100 to 99 and you'd get your $1. That's the way dividends work, right? Ex dividend date and you get the pay date. Great, 99 plus my one in cash. Thank you very much. I'm still at $100. Well, the options market knows that dollar is coming, and puts, which appreciate when a stock price goes down. Say that again. Put values go up in value when a stock goes down in value. Know that the $100 put, the $100 strike is going to be worth $1 more tomorrow than today after dividends are paid. Yet you don't end up owing the dollar dividend to anybody. So the option market doesn't let you buy that put without having the dividend, without paying for that dividend that everybody knows is coming. And so as a seller of options, you get to be on the other side of that. And you say, listen, I know $1 dividend is coming. I'll sell the put, capture that dividend. That is embedded in the price because it is an expected payment that will reduce the price of the stock and increase the value of the put. So, I mean, I think that's. I tried to explain that briefly with spreads. You could do some other things where you limit losses, and the dividend is more in there, and how much in the money. All of those things go into the math there. But I think what's important to realize is you can synthetically capture or mirror a portion of the dividend by selling puts or put spreads on a higher yielding vehicle. And if you're someone that ever looks at an option chain, I recommend you look at higher yielding ETFs like HYG or JNK, or you could look at stocks like J&J or Verizon. And you could see before the dividend, or even going out to when the dividend is going to be paid, you could see an increase in the value of the puts. And that is absolutely a factor that goes into the pricing.
I think it was either you or somebody else within ZEGA always used to say, look, when there's no free lunch, if a stock is trading at 100 and the dividend is going to be $5, you can't buy the $100 put for $2 and have a riskless trade, right? It doesn't work. Meaning your stock goes from 100 to 95, you get the $5 dividend, but then you only pay $2, so you net $3 completely risk free. It's not how it works, and thus the embeddedness. I think that's a word. If not, I'll just make it up in the put. So, I mean, talk about some of the benefits of maybe doing, a synthetic capture strategy as opposed to, having like a 60-40 portfolio.
Well, yeah, I'll tell you that there's two benefits. One, again, the predictability of the returns, because we know that the dividends are embedded in the options themselves. We sell options to capture that. Whether you want to use leverage to capture more, right? Wouldn't it be great to be like, hey, instead of buying 100 shares, I could sell 2 or 3 contracts and capture 2 or 3 times the dividend. Of course, you're creating more leverage, you create more risk, which is the second benefit that I want to talk about. When you use options, you can define your risk. The problem is when you own a stock, and if you own it just for the dividends, you take all that risk associated with the stock, right? So if you're hoping for an annual return of 5% in dividends from a stock or an ETF, the stock and ETF could go down a lot more than 5%, right? You're taking on additional risk associated with the underlying vehicle itself. But with options, we're able to actually limit that risk, right? We do spreads, as you mentioned a minute ago, where we're selling a put and buying a put farther down. The most we can lose is the distance between those two options. Now, that may limit the amount of the dividend that you take, but it severely limits the loss that you may experience. So what do I mean by that? So let's say, let's use HYG for an example. It's an 85, I guess it's an $82 ETF today. And you can do a spread that is, say, only 5 points wide, and you could sell that spread for $2. The most you can lose in that scenario is the difference between the strikes minus the premium you brought in. So $5, 80, and you get this dividend, the most you're going to lose there is like $3, right? So, but it's an $85 stock. The point is, I'm taking on a position. If it's all about capturing the dividend, I can capture the dividend in the option. And if the most I'm going to lose on an $85 stock or an $82 stock is $3, then so be it. I've also created protection while still capturing the dividend through the options. And so, Derek, when you talk about when I said, what is attractive about bonds in a portfolio, we could replicate that of regular income from a dividend or capturing it with the put selling, but also creating lower volatility because we're limiting the amount we can lose versus, say, just owning a stock like Johnson & Johnson or Verizon that can go, down to zero or down 50%.
Yeah. And I think one of the important things too is that what we're seeing, just anecdotally, just talking to advisors over the years, a lot of their clients who are near retirement or actually are in retirement actually need a little bit more growth than you think. And part of it is the life expectancy. Good news, people seem to be living longer. Bad news, you're going to need more money for longer. So I think, the idea of people still needing growth, it also points to, you've got in a 60-40 or 40-60, whatever it is, where you've got treasuries yielding next to nothing. It's tough to make the equity portion, especially as it gets reduced, work that hard, right?
It's exactly right. Yeah, I couldn't agree with you more. So, I don't want to go too deep into all of that and the time value and those types of things. But I do think, Derek, if you can solve the question for investors around creating an acceptable growth rate for 3, 4, 5% with traditional bond type risk, there is a real need for that in the marketplace.
Well, and I think if it is lower for longer or even lower for even longer, I think stuff like this is gonna continue to bubble up. I mean, look, you and I have been, as we kind of wrap up here, you and I have been, I think, on the forefront of this. We looked at what was going on in Europe several years ago and said, you know what? We just can't keep rates. Our rates can't stay that high. One, because the dollar would get too strong. But if on a relative basis, if you've got all these central banks and governments keeping rates low, and by the way, the debt is ever increasing, like there's no incentive for governments to have higher rates with all this debt. So who knows? Maybe it's even lower, even longer. But I don't know, Jay. We'll see at some point. So, all right, folks. Well, Jay, thanks again for coming on today. And of course, as the semi-permanent co-host, you'll be back on in the coming weeks. As always, send ideas for future podcasts. We like to get those. And a couple of the ones that I've done, in fact, some I've done with Jay have been listener requests. And I'll link to all the stuff. I'll link to the things that Jay is talking to. I'll link to Jay's book. Jay, your book is now in reprint. You just want to mention that real quick?
Yeah. Buy and Hedge, the 5 iron rules for investing over the long term. We did have a reprint. Actually, we changed publishers, right? So nothing really changed in the content, but we did have it reprinted, and it is available on Amazon, just like your wonderful book, Broken Pie Chart.
There you go. A good idea. So great July 4th gifts, Father's Day gifts. I'll link to those as well. Jay, thanks again for coming on.
Thanks so much, Derek.
All right. See you, everyone.